Moving averages are one of the most popular trading indicators, and in this video I will show you exactly how to use them in your trading, what they do, and what their best use cases are. And before we get into the charts, let me just briefly provide you a little bit of framework around indicators, and then we will dive into the charts. So the purpose of moving averages is that you can use them to determine the trend direction. You can also use them to look for trend strength. How strong is a trend, or maybe is it losing strength? You can use moving average to time directional changes. So when the market goes from up to down or from down to up, moving averages can help us, especially the crossover. We can use moving averages for pullback trading to get into trends again, and for many other things. Then the question that always comes up, what is a good moving average setting, short or long? And there are a few things that you need to consider. So here are they. The length determines the sensitivity of your moving average, and it determines the sensitivity of the trading signals that you get. If you choose a moving average with a higher setting, it will move slowly, but it is also less affected by noise, which we will see shortly. If you use a fast and a short moving average, it does react faster, but oftentimes it will also react too fast. So this is the drawback then. So it all has pros and cons. This means that there is no better or worse when it comes to moving average. It all depends on the trading style and the subjective or objectives that you are trying to accomplish. So which length? When it comes to length, I always recommend that you stick with the commonly used ones, big round numbers, 20, 50, 100, 200, 250 is very popular as well. And for a shorter time, shorter moving average, you can also go to the 10 period setting. Avoid jumping around. So what I always recommend, it doesn't matter which trading concept or indicator, avoid jumping around. Consistency is really the key. So you need to pick your set of moving averages and then you stick to them. This is very, very important. The key points is that you need to know when to use your moving averages and when they don't work. That's very, very important, obviously. And that is often where the misconceptions and the confusion comes from, because the traders use moving averages in wrong ways during wrong market conditions, and then they get wrong signals, and then they believe that their indicator doesn't work, which is not the case. Moving averages work great, but you need to know when to use them. Only use them when the market respects your moving average. Very important. There are certain markets where the moving average is respected more, and other markets moving averages are respected less. And this will change over time as well. There will be a time when a certain market respects moving average very well and very precisely, and there will be a time when the instrument and the market doesn't respect the moving average. It's an indicator, and the name gives it away. It indicates something. It's not meant to be a standalone trading system, but it can be used as confluence with your other tools, and then a moving average works very, very well. So let's get into some charts, and we are going to look at a few different settings. So right now, this is the 10 and the 20 period moving average. It's a simple moving average, and the first thing that we can always look for is that we want to look for a crossover in a moving average. That's very, very important. Whenever a long and a short-term moving average cross, it can signal a change in direction. So if I use the tool, you can see here is a cross. The white period moving average, which is the faster period moving average, it's a 10 period. It crosses over the blue one, which is the 20 period. And this then signals that the market has a higher likelihood of continuing rising. So you can see here, after the moving average has crossed, the market then rises higher. And then, because those are very, very short-term moving average, 10 and 20, we will shortly take a look at 50 and 100 as well. Those moving average, as I said, they are more sensitive, so they will cross more often. So you can see now the moving average crosses back below, here it crosses back above, and here it crosses back below. So here the moving average would have signaled you to go short, and here to go long, and here to go short again, until the last point when they cross back above is here. So you can see, okay, in this period you would have made probably money. In this period you probably would have made money as well. And here probably this was a harder time where you either lost or you got out with a break-even trade. Because although the moving averages crossed here, they didn't really show you a new, or it didn't lead to a new trend. And this is important to note. Nothing in trading works 100% of the time. It works reasonably well some of the time, and that is why you need to manage your reward and your risk ratio. So when the trades work out, you need to really learn how to let your trades run so that you can maximize your profits. And when it doesn't work out, you need to cut your losers quickly as possible, to minimize the losing. And then the reward and risk ratio will take care of your account balance. Of course, as I said also, the moving average is not meant to be a standalone indicator, so you could use it with other moving averages, or with other indicators, or with other systems and tools in combination. And then you can create more confluence. Let's wipe this clean. And one more thing before we get into the long-term moving average, you can see here, for example, and then also during the downtrend here, this is what we would call a pullback. So the market, when I zoom in a little bit more, you can see here the market was in a very, very nice uptrend, and then it moved back into the moving average. Here you can see that very precisely, and here as well. And then it continued its way up. So this is what we will call a pullback. The market pulls back to the moving average, then it finds support and moves higher. It pulls back and it moves higher. And those areas, when the price pulls back into your moving average, that is something that many traders will use as buying opportunities. So maybe you missed your first trade entry here, or you want to enter or add to an existing position. This can be done with during pullbacks. Here we can see it again, the market is in a downtrend, the moving average is crossed here, then the market pulls back to the moving average, goes lower, pulls back, goes lower, here it misses it a little bit, and then here it makes its final wave to the downside. And the pullbacks, they can be great trading opportunities to look for additional trade entries. So this is something that I also mentioned. Let's now switch this up and use a 50 and a 100 period moving average. And you can already see that they move much, much slower compared to the other moving averages. So let's look again at the crossovers. So here is when the short term, the yellow one, which is the 50, crosses above the 100. And then they stay crossed until here. And then they stay crossed until here, and then they stay crossed until here, and so on and so forth. So let's now take a look at this. So you can see, okay, here this is where the market showed an uptrend based on the moving average, here now a downtrend, and then now, oops, let me move forward, here another uptrend. And you can see that you have very, very different signals now. It is not better or worse. This time the higher moving averages, they filter out more noise. So when the market makes a sudden move, you won't see it as quickly in your moving average. You can see here, for example, the market had a decent move against you, but the moving averages didn't cross until later when the market really made a reversal. So this is also what you can see, the big difference in the different moving averages. And this is really why there is no better or worse. You can stay in trades longer, sometimes you will give back more profits, but in the end it really depends on what trading style do you want to have for your trading. Do you like the fast moving averages where you can react quicker to the moves, but also you have more fall signals? Or do you like the longer trends, or the longer signals where you can stay in trades potentially longer with the long-term moving averages? Another option when using long-term moving averages, even for short-term you can do that. So you could have entered a trade when they cross here, and then when do you exit the trade? When the price crosses one of the moving averages. So here you would have closed your long trade. Then you go short when the moving averages cross again, which is here, and then you exit when the price moves back into one of the moving averages. here as well. You enter long here when the moving averages cross, and then you exit here when the price goes back into the moving average. And another thing that we can see very nicely here, this is a very good pullback example. The market was in an uptrend, the moving averages crossed here, then the price dipped back, it retested this moving average, and then continued higher. So you can see with those longer period moving averages, the pullbacks will become less and less obvious. Here is another one, but they also work, but obviously less often, because it's just a higher moving average and you filter out more of the noise and it reacts just slower to the changing market conditions. So again, there's no real better or worse. I usually recommend using two moving averages together. They give you the best signals. So this is, and it's also more robust. What you should not do is use a very short term, like the 10 and the 100. So here, for example, this won't give you meaningful signals because the moving averages are just too far away from each other and they don't really work nicely together. Another option would be to create something that I call a channel. So let's adjust the 20 period moving average and create another 10 period moving average, but instead of using it for the close, we use one for the high and the other one we apply to the low, and this does now create a channel. So you can see that here we have a 10 period moving average channel, and 10 period might be a little bit too too fast for this market because it's not really respected. But let's try to see, okay, now we have a 20 period moving average channel. Now the moving averages, they cannot cross anymore because one is applied to the high and the low. So it's always going to be a channel that is showing on your charts, and you could use the moving averages in the same way. Let's move to a different market and see what we can find here. And you can see that this is this moving average looks very, very different, and the channel looks different across different markets. That is why I said in the beginning, you really need to look for what market are you trading. Is it more volatile? If it does swing more, you need to use a higher period moving average to just filter out the noise. So you can see here it always overshoots the moving average. This is an exotic pair, so it is more volatile compared to previously we looked more of a minor pair. We can also take a look at, for example, a major pair, and then we will see the difference right away, I think. And this is another interesting example. So although we are now on the US dollar Swissy, this is still showing us that in this market, this moving average channel is not very useful because the market doesn't really pay too much attention to it and overshoots it very, very often. So this is really how your own discretion comes in, and you need to always analyze and see, okay, for this market, I'm going to use maybe a 50 period moving average. And maybe when the volatility is lower, I will change back to a 20 period moving average. And over time, you can then adjust it. And then it is not a fixed system. You can really stay adaptive to the market conditions and always react with the best moving average setting. And as I said in the beginning as well, it is important to know when to not use a moving average. And when you not use a moving average is during a range market. So when the market goes sideways, for example, like it did here, then you stay away from using moving averages. They don't work during range markets. They only work during trending markets. In a range, what will happen? The price moves sideways, and by definition, the moving average will be in the middle of the range because it's the average. So you really can only use it in trending markets, such as here on the left-hand side, and then again when the market tanked. And how do you determine that? I am a very, very big fan of breakout trading, and I always try to look for patterns. Here in this example, we have a wedge here, and then or a triangle, or whatever you want to call it, and here as well. And those are consolidating phases, and you can see the market moves sideways, and where's the moving average? Right in the middle of price action. And here again, right in the middle of price action. And then the only thing you need to do is wait for a breakout, and then use your moving average to stay in the trade. And the same thing happened again here. You can draw your pattern, you wait for a breakout, and then you stay in the trade as long as your moving averages are not crossed. And this is then also how you can filter out scenarios when you don't use moving averages and when moving averages work better. And this is then how you can stay away from times when other traders use moving averages in the wrong way and then they get caught up in such a range market. But you hopefully now know better, and you can use the different tools and concepts to combine it for a more robust approach.